couple of weeks ago, I was out for dinner with a friend and we were sharing a plate of charcuterie and talking about personality types. He works for one of the super majors in the US, and as part of his employment there, he had to take a personality test. The topic of biases came up. Human beings are subject to emotional and cognitive biases, and it affects the way that we make decisions in everyday life and in our finances. But if those biases are causing us to have the wrong decision, or making the wrong decision over and over again, it can have a big impact on your financial success over time. Let's go through a few of those and talk about what it is that you can do about it. I'm Anna Hilberry. Don't forget to like and subscribe to my YouTube channel. So one of the keys to being a successful investor is to be humble and to be honest with yourself. Because if you're not humble and you're not honest, the stock market will humble you, and it will show you by making you lose money, and then you'll have to be honest with yourself about the decisions that you made and decide that they were wrong. So some of the ways that we can make the wrong decision are based on biases. And the first one that I'm going to talk about are cognitive biases. Now, Dr. Christopher Dreyer in Psychology Today posted an article in 2018 about cognitive biases, and he describes them as a systematic error in our thinking process. So basically, it's a heuristic, and what that means is it's a mental shortcut. So the way to think about this is that the human brain is inundated with so much information on a daily basis. It'd be really exhausting to actually mentally process all of that information. And so what the brain does is it'll take shortcuts. It'll say, oh, this belongs in that bucket and this belongs in that bucket, based on basically assumptions. But sometimes those assumptions are wrong. They're known as a bias. So let's go through two of those now. The first one I'm going to talk about is cognitive dissonance. Cognitive dissonance is basically an investor having a pre-existing belief about something, and then when they're presented with new information that contradicts their previous belief, it makes them feel mental discomfort. And in order to avoid that discomfort of being wrong, investors will go to great lengths to convince themselves that they're right. And this can lead to wrong decisions. So let's go through an example of this. I'm going to pick on Tesla because everybody knows the company. Let's assume you have a pre-existing belief that Tesla is an amazing company, you really like Elon Musk, and you believe it's a good investment. So you buy the stock. Then you start getting some new research reports that are coming out that are going against your previous belief, and it makes you feel uncomfortable, and you don't like that feeling, and so you ignore those new research reports and you just continue on with owning the company, when in reality it hasn't been making any money and you probably should sell it because it's going to result in a loss down the road. So this is a really good example of something that investors should not do, but they actually do it all the time. Let's talk about the next one, and that is self-attribution. Self-attribution is when you attribute anything good or positive in your life to your own behavior, and any kind of negative impacts or things that happen in your life to external forces. So what this can do is it can stop an investor from learning from their own mistakes. Remember when I said earlier that it was really important to be honest? And one of the key ways of being honest with yourself is when you've made a wrong decision, and you can say, hey, this was wrong, I made this wrong decision, and then you learn from it. Learning from your mistakes is one of the keys to becoming a better investor and a better human being. It's when we fail the most and then we learn from it, that's when you have your biggest growth and the potential to become a much better investor in the future. Let's talk about emotional biases. Emotional biases are a little bit harder to deal with than cognitive biases, because human beings are ruled by their emotions. And what your emotions are going to tell you to do as an investor is buy when people are feeling excited and maybe even a little bit greedy about the market, and sell when people are feeling fearful. When in reality, as Warren Buffett said, you should buy when people are fearful and sell when people are feeling greedy. So the first one I'm going to talk about is the endowment bias. Now, an endowment bias is when an investor places more value on something that they currently own simply because they own it, or they have some sort of emotional attachment to it. And the market on very liquid stocks and bonds, the spread is pretty small. And if you're adding a larger spread than the market can bear because you have an emotional attachment to that investment, what is going to happen is you're probably going to have that investment longer than you should. Classic example of this is when a person receives, let's say, in-kind inheritance of, let's say, I don't know, Bank of Montreal stock. So you have an emotional attachment to the Bank of Montreal stock because you associate it with your loved one. Now, let's say the Bank of Montreal is going through a prolonged period of difficulty and you should be selling it, but you decide to continue to hang on to it because of that emotional attachment. This can be a bad thing, and it can result in negative consequences for your finances. The next emotional bias I'm going to talk about is status quo. So the status quo bias is something that can actually act as a paralyzer for investors. And what it is when an investor basically doesn't want to make any decisions other than what they're currently doing. They want to maintain the status quo simply because they feel comfortable. And what this can do is result in you hanging on to a position longer than you should. So a classic example of this is when an investor has, let's say, a certain percentage in financials. And now let's say financials have done really well and that position has ballooned to a huge position in the portfolio. Let's say it's now 40% of the portfolio, and it's been like that. It's been growing over the years, but the investor continues to hang on to those financial sector, making up 40% of their portfolio, even though it represents a huge risk to the portfolio because it's an overly large position, quite simply because they like the status quo and they're comfortable with it. So this is definitely something to be aware of. Let's talk about some of the steps that you can take to mitigate the different biases that I've talked about. First step that you should take to mitigate the negative impacts of the biases that are probably affecting you, because of course we all have them, you have to be honest with yourself. You've got to be realistic about your capabilities and the decisions that you're making, and you have to be honest with yourself about those. Otherwise, you're not going to grow and become a better investor. Step number 2, hire a professional. If you hire a professional such as myself, we can help you steer clear of those cognitive and emotional biases. More than likely, we've seen them in clients before, and we've seen how it negatively impacts their portfolio, and we can help you. We can help you guide you around those biases so you can make better decisions. Step number 3, when it comes to investing, you always must make your decisions based on a rules-based methodology that you set up ahead of time before you started investing, and you did it by going through a logical thought process. Step number 4 is to challenge yourself. Challenge your rules and challenge the way that you invest, and look at if there's a way that you can do better and improve. Steve and I do this on a regular basis. It keeps us honest with ourselves and it makes us better investors. I'm Anna Hilberry. I hope this has been helpful for you. Thank you for listening.